Good evening, everyone. My name is Michele Ferrario. I'm the co-founder and CEO of StashAway. Thank you so much for joining us tonight for one of our webinars talking about new funds we are making commitments to. If you've been part of the private equity program for some time, you know the drill. So we're going to follow what we have been doing quite a few times and going deeper into the specific fund we're looking at today, which is Advent International GPA, which stands for Global Private Equity Fund number 11, as well as their Tech Fund number 3. And we look at them together. Now, before I start, let me remind you that there is a Q&A function in Zoom. Please use that if you have any questions at the end of the presentation. I'll make sure to carve out time to go through any questions you might have on this topic, okay? So let's start. This is a webinar only for accredited investors. If you're not accredited investors, you should not be part of this webinar. Now, making a step back, I'll assume you all know what StashAway offers, but as a quick recap, we have what we call a core portfolio, which is where most of everybody's money should be. It should be where 60, 70, 80% of your money should be for the long term. And it's a set of tools that enable you to build and manage diversified portfolios across asset classes. It's your, public equities, public fixed income, so, government bonds, corporate bonds, as well as real estate, as well as gold, in a portfolio that is managed to make sure that the asset allocation takes into consideration what's happening to the broader economy, what's happening to the markets. We have a few variations on the topic. We have the StashAway core portfolio, we have the BlackRock one, as well as we have flexible portfolios where you can build your own asset allocation. We also have an income investing proposition managed together with JPMorgan Asset Management. We then have a cash management offering. I'm not going to go through the details of that, but the idea here is that you will be able to get a much higher yield than you can get by taking the same level of risk elsewhere. I don't think there is anything comparable in the market, just because we charge much lower fees, and this is not rocket science, so there's not much you can do to increase the returns other than taking more risk or reducing fees. So lower than us, very difficult, and therefore that's the best you can get at those level of risk. Simple is a real kind of a cash equivalent fund. Simple Plus has a little bit more risk and currently yields 2.9% in Singapore dollars, and Simple Guaranteed offers guaranteed rates, in practice fixed deposits. Thematics, kind of, I guess, self-explanatory, so I'm not going to go into the details. This is to increase your kind of satellite allocations. You have your core, and then you want to, as your money becomes larger, you want to actually increase your diversification. There are a few options here to do it through specific teams. And then we have alternatives, which is obviously where which is what's most relevant tonight, because we're going to talk about the PEVC portfolio, which is the first at the top. Before I do that, let me briefly talk about everything else. We've also launched 3 semi-liquid private markets offering. Private credit, which we launched more than a year ago, and private equity and private infrastructure, which is recently launched. The idea here is to make it extremely simple to get access to private markets, again, credit, infrastructure, or equity, through a vehicle that is semi-liquid. So while our private equity and venture capital program makes commitments and invests in closed-end funds, we have a kind of lifetime of 10, 12 years. So in practice, your money will be illiquid for 6, 7, 8 years before it reaches break even from a cash flow perspective. The semi-liquid products enable you to actually withdraw money in practice anytime. We have a 1-year lockup, and after that, you can do it anytime. There are some, there is a gating at 5%, but in normal times, you should be able to kind of withdraw anytime you want. So obviously there are pros and cons to the structure. The pros is that obviously it's more liquid. The cons is that in order to maintain that liquidity, your target IRR will be slightly lower than a target IRR of a closed-end portfolio. If you have any questions on this, feel free to ask them, or feel free to discuss them with the wealth advisors in our team. And by the way, I didn't introduce, apologies for that. I forgot to introduce Janelle, who's also in the background today, helping me here, and she'll She'll speak later about how to start with the private equity and venture capital program later on. So thank you, Janelle, for being with us tonight. Apologies for not introducing you earlier. Yeah, here you are. Okay, perfect. Thank you.
No, thank you, Cal.
Okay, so now focus on what we're talking about tonight, which is the private equity and venture capital program or venture capital portfolio. This is a traditional program that enables anyone, any accredited investor that is a client of ours, to build a truly diversified portfolio of top-notch private equity funds globally. We started around 3 years ago, and we made several commitments. The target is make what we call 100% commitment every year, because in practice, we ask you to give us a yearly budget, minimum $50,000, and therefore, that's why we think about it in percentages. So what percentage of your yearly budget is being allocated, committed to a specific fund? I'm not going to go through all of them because at this point there are quite a lot, but you can see, a lot of interesting name, Silver Lake, this was a tech buyout, KKR, this was a growth equity fund, Lexington Partner, it's a secondary fund. HIG, for example, is a mid-market buyout fund. Moving on, in 2024, we've done General Catalyst, which was a growth equity fund. We've done CVC, Capital Partner. This was also growth equity. Vista, also a tech buyout funds. And then more recently, we've done HG and SquarePeg. SquarePeg is a VC. And now we're talking about Advent. This is 80% of the allocation goes to GPE, which is a large cap buyout, and 20% goes to the tech fund, which is, as the name says, is a tech kind of growth and buyout fund. Now, why invest in private markets? The first piece of this is that investing in private markets as part of an overall portfolio that is diversified actually increases your risk-adjusted returns. So what you see on this slide is 3 kind of classic public market portfolios. You have a 40% equity, 60 bond. Your class is 60-40, so 60% equity, 40 bonds, and a more aggressive 80-20. And on the right side, you actually see the specific numbers behind this table. If you add some alternatives, which is mostly private markets, within this allocation, this is math from JP Morgan, you're actually able to move the portfolios to the top and left, which means left means reduce risk, reduce volatility, and top means increase returns. So this is actually 30 plus years of data. So it's very, there's a lot of data behind this. And this is a combination of just aiming for higher returns, but also diversify further and therefore reducing the overall volatility of your portfolio. So this is the core reason to have part of your asset allocation invested in private markets. Another way to think about it is that if you specifically look at private equity within the alternatives bucket, private equity has historically outperformed public markets across all environments. So the way to read this slide is that from the left side, you have, so you read less than 5%, the minus 5%. This means that in the years when public markets, so S&P 500, have returned less than negative 5%, so in practice in bear markets or corrections year, public markets, private equity specifically, have returned close to 10% more. So the delta return has been 10%. As private markets do better, as you move right, so -5 to +5%, 5 to 10, 10 to 15, or more than 15%, that outperformance shrinks a little bit, but remains there. So the outperformance is there irrespective of market environment, and it's particularly strong when public markets are not doing very well. Again, and up until 10%, there is a very nice 8% extra return. That's a lot of money, 8% per year. Okay, so the idea here is that it gives higher returns and in a more stable manner, meaning that obviously if you plot it from a stability perspective, it'll show you that it's less volatile than public markets. Another way to look at kind of the same data is, okay, what happened in accumulated fashion? And here, the dark blue line is buyouts, the green line is MSCI World. So this is a kind of a comparison of returns. And as you can see, in the great majority of quarters, these are quarterly data, the blue line is above the greenish line. In fact, there are only 5 quarters since 2001. So in the last 24 years, in the last 100 quarters, there is only 5 quarters where the MSCI equity world has outperformed buyouts. If you then annualize what happened from a cumulative return perspective, buyouts have done 13%. These are median buyouts, have done 13% per annum on average, while MSCI world has done less than 8% per annum on average. So, and 5% is a lot of money. When it compounds, it actually becomes a very significant amount. So, we talked about it a lot. It does make sense. Once you get to a certain level of wealth and you can manage some illiquidity, it does make sense to have part of your portfolio invested in private markets, and the reasons are returns and risk-adjusted returns. So absolute returns and risk-adjusted returns. Those are the main reasons. The third reason will be diversification. You get access to opportunities that otherwise you would not get access to. And this is becoming more and more important because more and more companies are staying private rather than going public. In fact, the public markets have been shrinking in size from a number of companies' perspective. Now, let's focus on the specific funds we want to talk about tonight. So this is, again, Advent Global Private Equity Fund number 11, as well as Advent Tech Fund number 3. In terms of, and maybe making a step back on Advent International. So Advent is one of the OGs of private equity, been around for more than 40 years, headquartered in Boston, has been there since 1984, has more than 300 investors employed. So these are purely the investors, so a large team. While they are a US company, they've been very, very present in Europe since a long time ago. They were one of the early comers to the European private equity, and so they have a very strong presence in Europe as well. They invest across a number of sectors, from financial services and business services to industrial and technology, so kind of covering, and healthcare, so covering quite a bit. And they've been very, very successful. This is fund number 11, and as you can see from the size of the fund, $26 billion. Clearly, in order to raise this kind of money, you need to have delivered very strong returns throughout your history. So this is one of the kind of staple large cap buyout funds that are out there. The tech fund is a newer proposition. This is only fund number 3. It has the same geographical reach of North America and Europe, and invest in kind of a growth, what we would call growth equity, so late stage VC growth equity on the tech side, with a target size of $4 billion in raise. Now let's look at the numbers. So, and as you know, we always like to look at past track record and risk analytics to understand how a fund manager has performed. On the left side, you see the GPE fund. On the right side, you see the tech fund. The bars are total value over paid in capital. And as you can see, the mature funds, or the fund vintage 2008, 2012, 2016, are all around the 2 times money return. So for every $100 invested, they gave back around $200. 2.1, 1.8, and 2.1 are the specific numbers. The less mature funds are not there yet, but when you actually look at the percentage IRR, which is in practice taking into account time, you see that are actually very similar and getting there. So the expectation is that they'll get at kind of 2x returns, showing incredible stability. So the reality is that while in the first 2-3 funds, which you don't see on the slides, Advent was investing in much smaller funds that were giving, they gave back incredibly high returns, but also less predictable. As they matured as a firm, they started to invest larger funds and actually being able to give back much more predictable outcomes to investors. On the right side, you see the same charts for the tech funds. Obviously, this is much more recent. So the first one was only 2019. And so the numbers are still to be matured, but again, showing some promising early data with kind of a positive, with growth, you expect maturity to come later than with buyouts. And the fact that are both of them delivering around 10% IRR, only a few years after launch is actually a good sign that, show promise for the remaining other funds. And fund 2 seems to actually be performing better, even if especially when you double click on the portfolio and you see how widespread those returns are and are coming from. From a investment strategy perspective, you will see that actually the funds have been invested across sectors and looking at market opportunities across a variety of different sectors. If you look at the last one, so GPA 10, There is the bigger part of the portfolio is industrial, and that's been the case for the last 2-3 funds. But there is also significant allocation to to consumer and business financial services. Obviously, on the tech side, as you can imagine, the investments are all in tech. But again, here there is quite a bit of diversification between software, payments, and cybersecurity. And as you can see, the actual other segment is becoming larger and larger, which shows you that they're actually trying to go broader in terms of diversification. From a geographical perspective, as I mentioned earlier, this is a US firm that had a very long established European platform. In fact, as you can see, starting from GPA 6, the first fund you see here on the left side, actually Europe was half of the deployment, even bigger than the US. The only difference that you see in the recent vintages is that in the last couple of vintages, they started having some Asia Pacific allocation. So they've been building teams in Asia Pacific, and they are now at around 20% allocation to Asia Pacific. But the core remain US and Europe. Similarly for tech is mostly North America and Europe, 60-40 North America and Europe. Again, expect no changes here on Fund 3 for tech and Fund 11 for GPA. And when you look at cash flow, this is the famous J curve. So what this shows you is the net cash flow by vintage, and we actually show you here even the earlier vintages just to see a bit more history. And you can see how consistent they have been in delivering kind of a net break even by year 7, and then obviously significant kind of returns on capital after that. They have had a couple of vintages that actually were able to break even before year 5, but in large buyouts, you would continue to expect year 5 to year 7 type of break even situation. You start receiving cash flow when the curves move here. So a year 4, it's when you start to receive positive cash flow, because the first exits start to happen, which are the first investments usually. So, but it is seems to be a very predictable chart, which is good. You want a fund like this one to be a little bit of your safe side of the overall portfolio, delivering high teens IRR with predictability and with cash flow predictability as well. And also from a direct alpha versus public markets perspective, these are a comparison versus PME, so public market equivalent. The mature funds, you see, they're all delivering 2 to 4 percentage point per year extra return. This is actually 2% per year is actually quite a bit of money. I wouldn't look at the 2022 vintages, too early to say. This is a fund that is not even fully invested, so I wouldn't even look at it similarly for tech. It's too early to say, but in general, they've been delivering positive alpha throughout the history. And lastly, let's look at risk. What you see here is what is called impairment ratio. Impairment ratio is the percentage of companies that return less than it was invested in the company. So impairment doesn't mean that the company goes to zero. It means that I invested $100 in a company, and when I sell the company, do I get more or less than $100? And as you can see, across funds, the number is that the impairment ratio is around 10%, which means that for 90% of the company, the fund has been making positive returns. There is an exception in 2012. We looked into this to understand whether there was something to be concerned about, and this is actually driven by unrealized deals that are still on the portfolio, and so and actually doing quite well from a kind of a P&L perspective. And so the expectation is actually that valuations might be on the conservative side right now, and then at exit, they may actually be able to have a much lower number here. 10% is actually kind of standard in the industry when you compare it to Blackstone or CVC. You actually get Blackstone is a comparison for the GPE, while CVC Qatar is a comparison for the tech funds, is actually quite in line with historical numbers. So as you know, the process we always follow is do a due diligence on the past, look at returns in the past, and then ask ourselves the question, is there any indication that this fund manager might or might not be able to replicate the same performance in the future? And so we look at a few things. We look at the fund manager itself. We look at investment strategy, whether there have been any change. We look at the team and its stability, most importantly. And then we look at key terms just to understand that, if things are in fact up to standards and normal. So broadly speaking, we spoke about it earlier when I was looking at geography and industrial focus. That's not changing. So the overall strategy is not changing. And historically, the company has shown it an ability to be able to invest in established companies across sectors. We listed a few examples here. And bear in mind, you're not investing in these specific companies. These are companies that have been invested by previous funds. These are just examples of investments that Advent has done over the last few years. As you can see, we actually looked at quite recent examples. And you have from antivirus software like McAfee to market research, so kind of business services like Nielsen, to manufacturer of elevators, TKE, to space infrastructure, Maxar, et cetera, et cetera. So it's very diverse. And that tells you the ability of the company to actually source and deliver on a variety of different segment opportunities, similar to what I showed you earlier when I showed the by sector split. Looking at the team, this is the managing partners focused on GPE, so the flagship fund. And as you can see, all of them, with the exception of two, have been with the firm for more than 10 years. And actually, the majority has been with the firm for more than 20 years. So this is an incredibly stable team across all the sector specializations. So the way they are kind of organized is that while the fund is one across different sectors, the teams are actually specialized by sectors, and this is what size allows them to do, right? And at the head of every team, you have people that have been a couple of decades with the firm, and maybe another 10 years before that working in private equity at other firms. And the same is true for the tech side. There's obviously some cross-pollination between the GPE tech, which are people investing in late stage kind of buyouts, tech opportunities, and the tech, kind of specifically tech team that is actually kind of leveraging some of the knowledge from the GPE team, but also operating at an earlier stage and investing in growth equities. Again, here, obviously, you do have a couple of people that have kind of joined more recently. Both of them actually from TPG, and as obviously these are people that have invested in tech before in other places. But other than that, there are the team has been established and with the company for quite a bit of time. So I guess on team, it doesn't get better than this. These are people that have in practice shaped the world of private equity, both in the US and in Europe over the last 2 decades. We always try to look at risks, and one of the things that pop up is that when you look at the full history of GPE vintages, you will see that actually the early vintages, vintage 1, 2, 3, were smaller funds and deliver incredibly high returns, while the later vintages have been more stable with much larger funds. And so the way you need to think about is investment in that you're not trying to get 50% IRR, you are trying to get a core part of the portfolio at high teens IRR as a core part of your overall private equity program. As you know, in the program, we also invest in mid-market players. That's where you actually will see probably more volatility of returns, where you can aspire to have higher returns as well as for growth and VC. And then the second potential risk is saying, okay, but while GPE is a fund that has enormous history, this is the 11th vintage, what about the tech strategy? This is only the 3rd vintage. The first vintage is only 6 years old. And what actually makes us think that this is not a risk, or a few things. First, while this is a newer strategy, part of the team has been with the company for a long time and was invested in tech before with Advent. And so there is no real team risk. Second, when you look at tech fund 1 and 2, they're actually delivering quite positive results. And Tech Fund 2 in particular actually seems to be delivering even stronger results than Tech Fund 1. And lastly, it's 20% of your allocation, so it's more of a kicker to the overall allocation than a core part. When you think about it from your overall portfolio, if you think about your yearly budget of 100%, the full Advent allocation is 15%, 80% goes to GPE, 20% goes to tech, which means that of your overall yearly budget, only 3% goes to tech. So it is a small sliver. It's a bit of a kicker on the overall allocation. Terms, very standard. Advent is GP, so the GPE fund is trying to raise the same amount that they raised in the previous vintage, around 26 billion. It was 25 the previous vintage, and the tech fund is also being stable at $4 billion. They're quite flexible in terms of investment size. The $26 billion fund, of course, does large investment. They can go down as low as $100 to $200 million equity check, but obviously you see the majority of investments in the $500 million to a couple of billion dollars. Obviously, the tech fund invests at smaller check sizes in the around $50 to $300 million range. Term is a classic 10 plus 1 plus 1 with a 6-year investment period, and management fee is 1.5%, which for the large cap fund is in line with market. For the tech fund is actually low. So we are benefiting from the fact that we're investing in both with lower commitments, and carried interest is 20%, as you would expect from any fund. So the last point is, how does this fit into your overall private equity and venture capital portfolio? And as you know, we have a target both on the geographical allocation and the strategic allocation. And on the geographical allocation, the target is 60% buyout, 20% growth, 20% venture. Sorry, on the titles are swapped. The left side is strategic allocation and the right side is geographical allocation. So anyway, on the left side, the strategic allocation, 60% buyouts, 20% growth, 20% venture is our target. We're currently slightly overexposed to buyout at 68% and slightly underexposed to both venture and growth. This allocation kind of keeps it flat, actually slightly increasing our allocation to growth thanks to the tech fund, and decreasing the overall allocation, slightly decreasing the overall allocation to buyout. But we're talking about tiny difference. So in practice, it keeps the allocation flat. On the geographical allocation on the right side, the target is 60% on America, 30% Europe, 10% Asia. We are slightly over allocated to Europe slightly over allocated to the US, and these are kind of the Advent investment slightly improved this by reducing US allocation in favor of European allocation. But again, these are tiny changes. It is not going to move the needle. The main reason why we are under-allocated, so over-allocated North America, is that the North American market has been just extremely active over the last few years, while Asia, as you know, has been more difficult. And here is actually APAC more than Asia. And Europe has also been, until recently, less active than North America. So I will stop here, give the mic to Janelle, and remind you that if you have any questions, there is a Q&A button on Zoom. Please use that. As soon as Janelle has kind of explained how you can get started or how you can invest in the program, I'll go and see if there is any Q&A. I understand there is a lot of people on the call that are actually veteran of this, so there might not be as many questions as in the past at this point. Janelle, over to you.
Thank you, Michele. So, hi everyone, Janelle here. I'm part of the Wealth Advisory team here in Singapore. So, how to get started with StashAway? So, basically, how we run our PEVC program. Michele, can we go to the next slide? So very much how we run our PEVC program at StashAway is to build an all-inclusive diversified portfolio. There are a few steps which you guys want to take into consideration. First is definitely thinking about how much of your overall portfolio would you actually want to allocate into private equity, right? And with that, the strategy really is to invest this particular budget into in a diversified manner, right, across geographies, strategies, and in this case, probably vintages as well, into at least 5 to 7 funds for you. So in terms of due diligence, this is taken care of by us. As what Michele mentioned previously, we benchmark across different sectors, different vintages of the funds, and of course, we select top tier private equity investment managers, as you can see from the past track record that we have. And lastly, we take care of the capital call management for you as well. So what we usually advise clients to do is to leave your money in the USD cash yield portfolio or any cash portfolio per se, where we basically draw down from that. So your cash is basically maximized. So it's not sitting there, sitting idle or not doing anything. It earns a certain yield, cash management yield, and while it takes for the capital to be called. Next slide, please. Okay. So the advantages of investing with StashAway for PEVC, I think firstly, the way we run PEVC with a very low minimum of 50K USD, we aim to invest this across 5 to 7 funds for you. And I think this is something that you will not be able to find in almost across any platform. So I think we do it in a very diversified and accessible manner. We definitely, based on the due diligence process, get access to some of the best private equity funds, tier 1, tier 2 private equity funds, which historically are very hard to get access to, have very high minimums, or have very high fees, or a combination of all. And lastly, based on how StashAway has always been, in terms of our philosophy, is just to keep it very simple, right? We source, we analyze, we allocate the investments for you, so you don't have to be constantly doing your own due diligence and making sure how you would like to allocate your portfolio. Next, please, Michelle. So we are here to help. Have a chat, reach out to me and my colleague Vincent, Kimi, if you have any questions, and feel free to reach out to your wealth advisors for those accredited investors who have already been assigned one. Discuss with them, share your thoughts, and we are here to help. So now back to you, Michele, for those who have any questions.
Yeah, thank you, Janelle. I see a couple of questions. Let me go through that. And if you have any more questions, please feel free to, again, use the Q&A button on Zoom, and I'll get to that. So the first question is around allocation. And Janelle just spoke about, how much you allocate to private markets, and how can you think about the differences on the semi-liquid allocations that I mentioned at the beginning versus these closed-end funds. So obviously, I cannot provide advice through a webinar. I don't know, who are you and what are your specifics. Well, I can give you some benchmarks. So if you look at institutional investors, they tend to invest somewhere in the 25 to 35% of their overall asset allocation into private markets. I'm talking about a GIC, Temasek, Harvard Endowment, and kind of those type of investors. We see ultra high net worth doing similar things, maybe slightly lower, the 15 to 30%, and high net worth individuals, people that have anywhere in the 1 to 10 million US dollars range, historically had a zero allocation and are now ramping up and thinking about 10 to 20%. That's what we see happening. I personally have a bit over 20%. The investment in semi-liquid versus kind of a closed-end fund, so the closed-end program, can coexist. In my case, for instance, I have a significant allocation to this program, but I also invest in all the three semi-liquid: private credit, private infrastructure, and private equity. So first of all, private credit and private infrastructure give you access to just a completely different asset class. On one side, you're investing in credit, on the other one, infrastructure. On private equity, you get access to the same asset class. Obviously, one is in a semi-liquid way, the other one in a more traditional closed-end way, and you're just targeting slightly different outcomes. And on the semi-liquid side, you probably you're targeting 12 to 14% returns yearly, and you have the ability to liquidate those investments with quite a high certainty at any point in time. While on the closed-end fund, the program that we just talked about, the target is higher teens, closer to 20% IRR, hopefully over time, but it comes with higher liquidity. And so you need to think about your liquid needs over the next 10, 15 years as you think about how to allocate on one side or the other. I hope I clarified this topic again. The people that can help you the best on this are the wealth advisors, actually, who can actually help you think about allocation overall across overall portfolios, including general investing, which, remember, is where the core of your money should sit, your 60-70%. Here we are talking about the satellite. Here we're talking about how to spice up your returns and improve your diversification and your risk management of your overall portfolio. I don't see any other. Let me double check again. I don't see any other questions. So unless, Janelle, you have any questions for me, I don't see any question in your face, so I'm assuming not. So we can close the webinar here. Thank you so much for joining tonight. Thank you, Janelle, for supporting in the back. And if you have any question that comes up later today or tomorrow or next week, feel free to reach out through any of the contacts you see on this page. Okay. Thank you so much for joining.